It seems like we're experiencing a similar hype in the stock market as we did back in 2021. Companies like Tesla, Palantir, and NIO are reaching all-time high prices, and while they are great companies with long-term potential, we need to question the realism of these prices. There's an uncomfortable truth that needs to be discussed. Now, let's address the situation. Different perspectives have been shared, but we want to approach it from a different angle. We'll categorize the discussion into two parts: unprofitable companies and profitable companies. They require different considerations, especially when making long-term projections. Let's start with the unprofitable companies, starting with NIO. Currently, NIO doesn't have a clear path to profitability, let alone a chance of reaching a share price of $1,000 anytime soon. Even with generous assumptions on margins and other factors, we need to evaluate how much revenue they would have to generate and the number of cars they would need to sell to justify such a high share price. If NIO can successfully move downstream and maintain margins, which has been a challenge for them in the past, then maybe we can discuss the possibility of NIO reaching that $1,000 share price in the distant future. However, for now, the focus should be on getting on the path to profitability, generating the necessary revenue, and improving margins. Only then can we make a more accurate projection and determine if that share price is actually realistic for NIO.
Feel stuck with your finances? Move your money to SOFI. APY when you sign up for SOFI Checking and Savings.
Now let's talk about SOFI and that $500 share price for SOFI. When compared to NIO, SOFI is further behind in terms of profitability and having predictable revenue and earnings per share. Although that share price could be realistic if we are being very generous with our projections, there are some challenges that SOFI is currently facing. For example, as they move into traditional banking, they will experience slower growth rates and increased expenses due to regulations and compliance issues.
I was having relationship issues with my old bank. Next to no interest, the fees, it was just take. So I broke up with bad banking and moved to SOFI Checking and Savings. Now I get 1.25% interest, pay no account fees, and get my paycheck 2 days early.
Break up with bad banking. Get 1.25% interest, pay no account fees, and get your paycheck up to 2 days early. Download the SOFI app and earn up to $300 when you set up direct deposit. SOFI, get your money right.
While SOFI is creating efficiencies, there will still be hurdles to overcome in this new landscape. It's important to acknowledge that growth rates may slow down from the impressive numbers they have seen in the past. However, it's necessary for SOFI to enter this space for long-term success. Another point to consider is that as SOFI starts to resemble a traditional bank more and more, Wall Street may start valuing it as such. If a significant portion of SOFI's revenue comes from banking activities,
I was having challenges with my old bank. Lots of red flags. Yellow ones too. Fees, penalties,
unnecessary fees,
playing dirty. So I broke up with bad banking and moved on with SOFI Checking and Savings. Now I get up to 2.0% APY on all my money and pay no account fees. Feels good to get my money right.
banker disqualified.
Break up with bad banking, get 2.00% interest, and earn up to $300 when you set up direct deposit. SOFI, get your money right.
it becomes difficult to view them solely as a fintech company. Wall Street might assign a lower valuation multiple to SOFI, similar to other traditional banks, rather than placing them in a separate category with innovative fintech companies like PayPal or Square. This means that in order for SOFI to reach a $500 price target, it would require significant institutional investment rather than relying solely on retail investors. The journey to reach that price target becomes more challenging, considering the realities of how SOFI is perceived and valued by the market. Let's move on to the profitable companies, starting with Tesla. There's a $3,000 price target being thrown around, but I have some doubts about it. The target is based on assumptions like full self-driving and a robust robo-taxi network. Some may argue that the same skepticism was voiced before when Tesla hit previous price targets, but none of the factors supporting those targets actually materialized. Elon Musk's execution surprised everyone and propelled the stock's performance. However, even if I were to take a bearish stance and predict Tesla's stock to drop significantly, it wouldn't necessarily mean the underlying thesis is correct. Unexpected events, such as a scandal involving Elon or a decline in EV demand, could impact the stock price independently of the original prediction. So, while I don't see a clear path to the $3,000 price target for Tesla based on the current factors, it doesn't mean Elon can't execute and achieve it in the future. Among the stocks we're discussing, Tesla has the best potential to reach that target, but the reasons and timeline presented may not align with reality.
I'm Meredith, and I'm a deployment strategist at Palantir. During my time as an active duty Air Force officer, I saw firsthand how hard it is to navigate the fog of war. Over the past 20 years, we've been focused on the counterinsurgency fight. And all that time, our near-peer rivals have observed our actions, learned our capabilities, and grown bolder.
The South China Sea is heating up.
Vladimir Putin tells the U.S.
A North Korean nuclear attack could be
Tensions between the U.S. and Iran are
near Taiwan as tensions escalate.
Now that the focus is shifting to great power competition, the real question is, can we deter the next great war? As a notional example, an escalation could start with something as simple as the Chinese military conducting a routine exercise in the South China Sea. To see the full picture and make tactical, operational, and strategic decisions, the U.S. and allied forces rely on Palantir. Monitoring the exercise, AI models running on satellite data.
Let's discuss Palantir, a stock that we've been following for a long time. While we believe in the company's potential, projecting its growth rate is challenging. Furthermore, as Palantir moves towards more traditional banking services, it may face regulatory hurdles and slower growth. The real question is whether Wall Street will assign a traditional bank multiple to Palantir, considering its profitability. It's difficult to determine if Palantir can reach a $500 price target within a specific timeline. Projections beyond 5 years become pure speculation and guessing. These long-term projections rely on everything going perfectly, which rarely happens in the market. Unexpected events, changes in leadership, government regulations, and geopolitical factors can impact a stock's trajectory. It's crucial to understand that projecting 5 or 10 years into the future is speculative and may not align with reality. While it can be fun to create projections, they hold little value when making investment decisions. Speculative numbers can even disrupt your decision-making process. Instead, focus on current information and trends to assess if a stock is right for you. See you on our next one.